interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody, and welcome back to the Private Equity Podcast. Joining us today is Ferdi Roberts, the founder and chief executive of Asset Class. Welcome, and thank you very much for sharing your insights, Ferdi.
Thanks, Alex. I'm delighted to be here. Appreciate the invite.
My pleasure. As is customary on the podcast, if you could give us a 60 to 90 second breakdown of you, please.
Sure. So as Alex mentioned, I'm the CEO and founder of Asset Class. We focus on the private equity and venture capital sector. I mean, more broadly, the private capital sector globally. We're a software provider, and so we focus on providing technology for those companies to handle what we refer to as the investor lifecycle management process. So that's everything from onboarding an investor into a fund, giving them visibility of the fund, going through compliance checks to ensure suitability and accreditation, depending on what part of the world the investor is based, right through to onboarding them into an investment and then managing that investment on an ongoing basis, rather the communications associated with that investment with the LP. So capital call management, distribution management, any communications they have relative to the fund performance. And then on the front end of that, helping venture capital companies and those that are involved in the due diligence process manage deal flow. And once they've invested in a company, manage the interaction with that portfolio. So whether it's a portfolio company or commercial real estate, managing that asset and the information flow from that asset back into the company and then ultimately back out to the LP. So it's the entire life cycle of an investment, but with a particular focus on those two sectors in particular.
Perfect. What's one mistake that you see private equity firms or their portfolio companies making, and what actions would you suggest to correct them?
Well, the thing that I have obviously a particular bias because I come at this sector from a software perspective, and what surprises me on a day-to-day basis, and we deal with private equity and VC companies around the world. About 80% of our clients are US-based, the rest are European. But the most common challenge I think we're addressing for these companies is the lack of adoption of technology in their own business. So whilst they've been very proactive going out there and investing in tech companies themselves, the adoption of technology within their own business is pretty variable. So it's not unusual for us to speak with a company who may be 500 to $1 billion in AUM, still managing those funds on very basic CRM, perhaps spreadsheets, as kind of the lowest common denominator. And obviously, most of the individuals that we're talking to are financially gifted in terms of how they structure deals and identify opportunities, but technologically, I won't say backward, but perhaps less adoptive of technology in those sectors. So that's the most common mistake that I see is that there is this digital divide that's emerging in the sector. And some companies are very proactive, but a large percentage, which is a great opportunity for companies like Asset Class, a large percentage are still got to get on that bandwagon and adopt technology in the way that they should.
I appreciate technology to a certain extent is a continuous emerging and developing space as it touches every field of every industry. Mm-hmm. Why do you think that PE and VC firms have maybe been slower? Because I agree with your statement. I think they drive technology into their portfolio companies, but maybe not as much, and a similar argument with marketing in private equity and venture capital. Why do you think there's been a lower adoption, or when they're not as utilizing the opportunities that technology brings to the actual firms themselves?
I think there's a couple of characteristics of this sector that let's say the most successful companies have exhibited. And the first and foremost at the center of these businesses is the concept of relationships. So relationships are crucial. They're crucial to identifying potential deals. They're crucial to engaging with potential companies or potential investments. That whole process of managing a deal is essential to the success of these businesses. And so the reliance on relationship is kind of first and foremost, that's kind of seen as the most important thing. And companies have spent a lot of time doing that and developing that, and rightly so. That is, people buy from people, people invest in people. As much as they might like the idea, they're ultimately investing in the person or group of people. So I think that that's been both a plus and a minus. It's been a plus to the extent that the understanding of the relationship has been first and foremost. I think where it's been a minus is that there's been an over-reliance on relationships to move a firm forward, and perhaps less of an appreciation of how complex those relationships can become, how important it is to connect the dots, which the human mind can handle so much, but ultimately you need to have some underlying technology there to help you gather and connect the dots. So we work with companies who invest in company A. Company A has relationships with companies B and C. That's a potential conduit for the company if B and C are looking to raise capital, but those relationships aren't necessarily connected in people's minds, but they can be connected in the technical realm, right? You can identify that this company here has representation, or perhaps as a client of company B, and perhaps as a conduit there. So I think that that's something that we see is that there's that over-reliance, and perhaps the digitization of the process isn't as well understood. I think the second challenge that we've got is, and I mentioned it briefly earlier, financially, the people that we talk to are very strong. And for whatever reason, the technology, I think they appreciate the benefits of the technology, but actually the technical appreciation of the technical options that are out there aren't as well understood. And what we've seen is typically a company has a problem, and as you'll know, in the private equity sector, it's full of problem solvers, right? First of all, they're looking for companies that are out there solving problems. But if they have a problem themselves, they'll typically go and buy a point solution, fix that problem, and move on. And that was great. One of the things that happened in the software sector over the last 10 years or so was this kind of decoupling of technology, right? So it rather than going out and investing in a large ERP system, you could go out and find a problem find a solution rather to a problem that you had around managing deal flow or CRM or something of that nature, onboarding. That's technology is now going through a process of recoupling, because people realize, well, I've bought solution A, B, and C, but they don't all talk to each other. And in fact, A is moving in a slightly different direction. And yes, they sold me as being an open company and I could share information via API, but actually I don't have that many tech skills. I don't have the tech skills in the business. So that kind of dream was the bubble was burst on that. So a lot of companies are finding themselves now looking at, okay, how do we get a platform solution for it? That's where we come in. So I would say that I'm not negative on the challenges that they have. It's a great opportunity for us, and actually a great opportunity for the companies themselves to help to differentiate themselves, because I think there is that digital divide between those companies who are adopting technology to move themselves forward, not just for their own benefit, but for the benefit of their LPs. The LPs have a nice portal that they can go to see the breadth of their investments, how those investments are performing. And as you know yourself, the change that's happening in the market, the growth of the millennial community in fintech in particular, and in financial services more generally. The average age of the millennial is now kind of in the late 30s, early 40s. They're getting to positions of senior management, and they want technology that is integrated. It's available 24/7, etc. And I think a lot of the PE companies are still stuck in kind of office hours, from a service perspective. So I think that's a challenge that we see, pretty regularly.
Makes sense. And you mentioned there your platform kind of solves a bit of a challenge between LP and the actual private equity or venture capital firm. Yep. What are some of the, I suppose, frustrations that you saw at LP level that made you make changes there?
Well, what's interesting, and that's exactly the position that you want to put yourself in as a PE company or VC for that matter, is what is the LP experience like? And so just to give you an example, I won't mention the company's name, but we work with a large company in the US, and for various reasons, they have relationships with 3 or 4 different fund administrators on the back end. So they launched a number of funds over the years. And because of the type of fund, the fund administrator on the back end is different. And so if I'm an LP who is invested in across a number of those funds, I have 2 or 3 different portals that I need to log into, perhaps not even a portal. I'm getting emails from different companies, from different fund admins with different URLs. And despite the fact that my relationship as an LP is with the PE firm. And so the PE firm has kind of organically grown and lost a bit of the relationship that they have with that LP by virtue of the fact that the provider that's sitting behind the fund, is this third party. And so we see that fairly regularly. That's often one of the challenges is if you actually step back and let's say it comes to tax season and that LP needs to pull together their K1s or their tax documents or statements, they have to log into all of these 3 different portals. They end up, in fact, normally calling the PE firm. And of course, that causes all sorts of challenges. There's a month to 6 weeks of pure pandemonium internally while they try and get their arms around all of this. So it is a bad experience. It's challenging because of, quite rightly, these are the majority of the companies that we work with, they're dealing with regulated securities. So there are a number of hoops that you've got to jump through from a compliance perspective, a suitability, accreditation perspective. And if you put that on paper and you're sending out docs, whether they're PDFs or whether they're hard documents, in many cases, companies are still sending physical PPMs out to people, numbered in the top left. I mean, it's just crazy. It's archaic. But if they do, those documents are coming back. And because the LP is doing their best to complete those documents, they're full of errors. So somebody has to get on the phone and talk them through it and perhaps send those documents out again. So the experience is very frustrating. And there are ways, in which technology can really help address those, cut down on these not in good order errors, make it easier for the LP at any time of day or night to view their relationship with the company, apply to invest in a new fund, get through the subdocs without having to repeat every single time that they subscribe to a new investment, having to add the same information across multiple investments, super frustrating. And it kind of suggests to the LP that you're not that worried about how valuable their time is, which is not a good message, right? So there are lots of ways in which we can help and companies like us can help by applying technology to the problem. And so, in the words of Mark Andreessen, where software is eating the world, the private equity sector itself is no exception to it. In fact, you could argue it should be one of the early adopters, but it hasn't been.
Yeah, I completely agree. I think there's elements of different business functions that are lacking in private equity, and one of them is definitely technology.
Yeah.
So Ferdi, just to get into your background a little bit, obviously doing a bit of digging, you've found a kind of multiple successful companies. What's enabled you to be able to create and build so many kind of different organizations?
Well, I've always been quite entrepreneurial, and so while I started my life actually working in London for about 18 years, and originally worked for US software companies, well-established brand names, Cisco, Yahoo, companies like Ariba were purchased by SAP. It gave me a great grounding in software, a great grounding in sales, which is kind of my first passion, but also the exposure to technology, which is my second. So kind of a self-taught technologist. And I've always had a great interest in it. And so once I'd been through the process of working for the company, seeing how they worked, benefited from, let's say, large company infrastructure, and wanted to do my own thing, the natural kind of progression for that for me was to start my own software business. And so I guess most pertinent, more recently in the early 2010, I started my own software business, a company called SaaS Markets. I moved out to the West Coast, lived in San Jose for a number of years, and grew and sold that company after about 4 years. And during that time, I'd been through a couple of fundraisers. We didn't raise that much money for that company, but it exposed me to the private capital markets and what that process was like. as a software business trying to raise money to expand my business. And of course, I was completely green. So, you go through that process, and you ask all the stupid questions, and you get kind of schooled on, well, here's what you should have done, first time around, and this is what shape the company should have been when you raised capital. And so you make all of these mistakes, and but I think it's a very necessary journey, and it was a great experience, growing that business and selling it. That business was ultimately bought by a European business. I'm from Ireland originally. I ended up being acquired by an Irish organization that had a large footprint in software and cybersecurity in the US, and to a lesser extent, about 30% of its business in Europe. And so as part of that earn-out, worked for them for 3 or 4 years as their COO, but always wanted to get back into the software business. And just as I finished my earn-out at that company, was contacted by the founder of a private equity company whose paths I crossed with while I was raising capital for my own business. And he said, look, we're growing. They were really a family office that was becoming a private equity company. They had launched a couple of funds and had a reasonable number of investors, but by comparison, there were 700 or 800 investors, which is quite large compared to some PE companies. But they were focused more on the retail end of the market. And so I met with him. He said, look, you're a technologist. I've got some problems with my back office. Could you come and take a look and see if you could recommend a way forward? And so I did, and I actually ended up joining the business and heading up their capital markets division and rationalizing their tech infrastructure, and worked in private equity on the other side of the equation for about 4 years. But what it gave me, Alex, was an exposure to everything that was wrong, technologically speaking, with that sector. And I just saw a huge opportunity because we worked with other PE companies, we worked with other VC companies, and we operated across a number of different asset classes: commercial real estate, technology, and energy. And so as a result of that, I could see that there was an opportunity for a company like Asset Class. And so when I proactively decided to start the business, it was exactly with that in mind. It was really starting from a blank sheet, saying if I was to build something from scratch here, what would it look like? And so that's where Asset Class came from. So for me, it was the most natural progression, through coming from the software sector, starting my own software business, being exposed to private equity, and now the melding of the two, which is really software for the private equity and venture capital space. It was a perfect marriage for me.
You mentioned a couple of bits in there I'd like to question on. One was, you mentioned some of the challenges and things that you went through. What advice would you give to either private equity or venture capital firms to make it easy to connect and contact with, people like yourself who are out there raising capital? And two, what advice would you give to somebody that's in that situation right now, who's maybe either raising capital or going through a process, either VC, exit, PE? I went through this, and I'd watch out for that kind of scenario.
Yeah.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast.
Well, I think that, starting with the company itself, first of all, my experience would suggest that you need to get out there and engage the market earlier than you think, with your product, even if the product is not fully built. In fact, I would say preferably before the product is fully built, because the market gives you instant feedback on what's working and what's not. And I saw a quote interestingly recently, which was kind of tongue-in-cheek, but I also think it's very accurate, which is that startups need to have two kinds of people. First of all, a group of people who will go out there and practically sell a product that they've not yet built, and then enough people internally that are embarrassed enough by that to go and build a product that the market needs. So it's kind of a push-pull, but it's a natural tension that I think, particularly if you're in the software business, getting out there and getting feedback from your target market is a great way to ensure that any money that you're spending on building the product is for a market that wants it, right? Because you can go so far down the road, and I've experienced it myself where with our first company, we had a pretty much a fully built product when we brought it to market, but we could have brought it a lot earlier. And in fact, if we had, I think we would have had a better product further down the line, and coincidentally more revenue. So when you start a business, you're not looking for mass adoption right out of the gate. You're looking for that 1 or 2% of people who get what you're doing. They're early adopters. They're willing to work with you and take your product at a point in your growth that they feel comfortable with, right? That they feel like, okay, as an early adopter, I'm happy to take this technology from this company that is still fledgling. I may not even be here, a year or two from now, but I believe enough in the people that are doing it that I want to invest. And that's quite a small percentage of people, right? It's those early adopters. So that's your job day one, is focus on that. And if you can do that and learn from them, then you can quickly develop a product that has more mass appeal and will increase your chances of getting to the next stage. So that's kind of, I guess, just a peek behind the curtain of a software business. Some of the things that nobody would really like to admit, that you've got to, puff up your chest, appear larger than you are. I'm not suggesting make commitments that you can't stand behind, but I do think that it's acceptable to go out there and say, yes, we're going to have that capability by the end of Q2, even if you haven't started to build it yet, as long as you believe you've got the resources to go and do it. And if somebody makes a commitment to you, that you go and do it, right? So that's uncomfortable for a lot of people. It's kind of in that gray area when you're growing a business that nobody really wants to admit to, but ultimately you've got to do, right? You have to appear larger and kind of make yourself bigger so that people take you seriously, particularly in the early days. So that's on the, let's say, on the portfolio side of the business. For private equity companies, I do think that there's a big opportunity for PE companies to differentiate themselves through technology, just as many other companies are, virtually every other sector globally. It's those that are adopting technology and running with it that are becoming, the differentiated service providers, whether it's disruptors in retail or disruptors in fintech or disruptors in almost any other market. It's that adoption technology that's important. And so I think that for PE companies, I think they do a great job on due diligence. So I don't have anything to add there. We just been through a raise ourselves recently, and it is incredible to see the level of detail that companies are going to now. But I think that's a natural byproduct of what's happening in the market. We raised just before this, let's say, great repricing, great revaluation that's going on. So it was good timing for us. But I think they do a great job on that. I think they could move more quickly and get deals done a lot quicker than perhaps they're doing today if they adopt the technology perhaps more aggressively. And that gives them competitive advantage. The ability to move quickly, speed is obviously a key differentiator, particularly if you're in a competitive situation with companies who are looking to raise capital now. And I guess finally on that point, in this market, which has just been through this great repricing, I think it is very challenging for companies to go out there and raise significant amounts of capital. What I'd say is, reset your expectation. You need to cut your cloth accordingly, and you don't want to have to go out there and raise and give away the farm just to raise enough money for the runway that you think you need. I would say pare it down, raise a little bit smaller. Give yourself some additional runway with the intention of going out and raising perhaps again in another 6 months. But I would suggest that people do it incrementally at this point, because if you're looking for the next big raise, you're in a down market now. You are going to give away far more than you need to for another 2 or 3 years of runway. I would say look at the next 12 months, raise enough to give yourself that, and go execute hard, right? Focus on managing that runway really aggressively, and create those options for yourselves. But don't go out and give away the farm right now. You'll regret it when the market does, as it inevitably will, rebalance and the pendulum swings back a little bit more towards the norm. It had kind of swung wildly out to, 30, 40x multiples for some companies. And now you might be struggling to get, high single digits multiples for most of the companies that we look at.
Yeah, that's interesting. Really interesting. Thank you for sharing that. What are your perception of what 3 attributes you believe make up a top performer, please, Ferdi?
Top performer in terms of the company, or in terms of the market, or
usually leave that to open to interpretation, but I'll say like whether it be a private equity investor, portfolio exec, that kind of individual. What 3 attributes do you believe make a top performer?
Yeah, I mean, for if I look at, I'll look at it from 2 perspectives. First of all, when I look at it in my own business, your attitude is everything, right? So I would prefer to take somebody. The private equity sector is incredibly closed. I mean, that's one thing that you quickly identify once you get involved in the sector. Proximity is everything, and very few people get proximate to the decision makers, the deals, the insights, etc. And I think that if you're bringing somebody into that sphere, I would prefer to bring somebody who's got the right attitude, but maybe not enough experience of the sector, than somebody who's got great experience of the sector, but maybe a little bit jaded. I've seen this all before. I've been through this. That's just my personal preference. I came to this sector asking the questions that I'm not sure people who are in the sector would have asked, because it might have been a stupid question like, why do we do this? Well, the answer is because that's the way we always did it. And for me, as a technologist, as an entrepreneur, you're looking for problems. I definitely saw problems, still see problems on a day-to-day basis. I think there's a certain amount of naivety that is required in order for you to identify the problems, because if you have experienced it, having worked in the sector for the last decade or 2, you're kind of blind to it. And I see it when I meet with the senior executives, GPs in these funds. I mean, there is kind of there's almost an embarrassment on their parts that, it is, when you put it like that, that's pretty bad that we treat our investors in that way, or that they have that kind of experience. And they'll normally just play back to you, hey, I invest in funds and I have that experience as well. So yeah, you're right. This is pretty poor. But look, I think that first thing, that attitude is particularly important for people coming into the business. It's not super fashionable to say this, but I think work rate is hugely important, right? To step away from the pack. I'm all for work-life balance, but I also think that I work very hard, but I enjoy my work, right? And so I'd say to people, or actually actively encourage people who aren't enjoying the work, go find something else to do, right? I want people who enjoy working with me, and enjoy working in this sector and are excited about the possibilities. And that in itself, if you can solve for that, everything else is the natural byproducts of it. They'll feel successful, they'll feel fulfilled. I'm not looking for workaholics. I want people who feel like for me, work is part of my life. That is that balance, right? And even if I take time off, I still enjoy understanding what's going on. I enjoy hearing about the deals that are closing, and I want to be there for my clients, for the team. So I think work rate, if you're hiring the right people, that will kind of solve for lots of the other challenges you see in a typical business. I think the third is, quite honestly, it's luck. And I know that you have the old adage, you create your own luck, and combination of the former, which is you have the right attitude and you got the work rate, you stick at it, you are going to have an element of luck. I mean, there's no question that this solution, the market that I'm in now, if I was to address this market 10 years ago, I may not get the same reception as I'm getting now. So timing is important, luck is important. If I didn't get that call from that former GP from that PE company, I may not have been exposed to the problem. So I think that you do to an extent, you create your own luck, but at the same time you do need an element of luck to be successful. I think looking outside of it to some of our clients, we're the technology that's kind of underlying their engagement with both sides of the equation, the LPs, the money coming in, right, to the funds, managing the funds themselves, and then the money going out to the investments. I can certainly see of the companies that we work with, and we work with 400 plus funds around the world. I can see of the funds that are successful and the GPs that I'm working with, they're just passionate about what they're doing. They've got a hunger for knowledge, and I'm a real believer in kind of lifelong learning, and so I'll espouse that in the company. I'll encourage with people in the company, but they are, some of them are just polymaths, right? They have an interest in everything, right? And a deep knowledge of almost any subject you could bring up. I mean, encyclopedic. It's kind of, it's embarrassing, really. Some of them are so smart. But for those that focus on whether it's the energy sector or they focus on tech, or they've just got this hunger for knowledge that I think they, and indeed anybody who works in the team, needs to have, because that's where you identify opportunity. If you don't understand your subject matter, you're not going to be able to identify it. I use this analogy with my own team, and I asked them about their first car. So what was your first car? And it could be, let's say it's a Volkswagen Scirocco or something, right? And so mine was a Mazda 323, and this was back in like the late 80s, early 90s. And so when I was looking at buying my first car, it's certain criteria that I met when I bought the car. I had a budget and various things. But as soon as I made the decision, this was the car I was going to buy, of course, I started to notice all these Mazda 323s on the road. You still do it today. Whatever car you drive, you don't set out in the morning thinking, I want to see other people are driving, a Volvo or whatever it is that you drive, but you do notice it. Yeah. Because you're kind of attuned to it. And I think it's the same with anybody who's in this business, on either side of the equation. You've got to have kind of a passion for what it is. And if you engage yourself in it and educate yourself on it, you're attuned. And so you see other things that people don't see, right? You're attuned to the opportunity that presents itself. I think the very best GPs, have that. They naturally, and it's kind of contagious, right? This knowledge that and thirst for knowledge that they have. So I don't know if that answers that. I've been through a number. I'd say a number of them are shared both sides of the equation, but hopefully that answers the question.
Sure does. It sure does, Ferdi. Thank you for that. What do you love about the private equity industry, and what do you dislike about it?
What I absolutely love is the breadth of it. And what I mean by that is, we are kind of asset class agnostic insofar as we work with companies that run funds for crypto, some that are work for commercial real estate, others that are focused on tech companies, and right across the spectrum. And so the byproduct of that is you get exposed to so many different markets. And you think you understand the sector, and then you look at the subsectors. And so if you have an interest in that, which I do, I have an interest in technology in particular, but I've also been exposed to the oil and gas sector, and how companies in the oil and gas sector get valued, and how you measure productivity of these companies, and the whole kind of process of valuing somebody who invests in oil fields, right? Like, so it's the breadth of it that is super interesting. And when you think about it, whether it's anything that holds value, right, as an asset and has the potential to increase or indeed decrease in value, is fair game. So it could be fine wines, it could be watches, it could be cars, it could be crypto, it could be. So the breadth of what private equity and private capital, more generally speaking, addresses is the most interesting thing to me. And so we're solving problems for, let's say, the most common asset classes. So tech VCs and commercial real estate and energy, et cetera. But you have all of these, renewables and crypto and, NFT marketplaces and things that you just wouldn't otherwise have an interest in if you weren't in the sector. That's the thing I like the most. I think that the thing I like the least is kind of a byproduct of that, which is, it can be easy to I guess, create an echo chamber for yourself where you think like, I can't believe that people don't understand the value of X, right? And you see it every day. I mean, and whether it's NFTs or the I won't say the scams that are taking place, but some highly questionable decisions that are being made around certain emerging technologies and the investment that people are putting into, let's say, some of the cryptocurrencies and things like this, how that market is being manipulated because it's come to kind of mass, to the mass market. And I think that there's a lot of negativity that comes from the, let's say, the peripheral edge cases that are negative in nature that ultimately have a very damaging effect on what could be a great technology. The underlying technology of crypto, blockchain technology is incredibly powerful, and yet it's something that, despite the fact that we're looking to adopt it ourselves in our own technology, I'll talk more about the application of the technology than I will the fact that we're building some solutions on blockchain, because it has this kind of dirty connotation.
Yeah.
And so I don't know. I think that's a natural progression of any market. But I do think that there needs to be more regulation around that, and certainly some rails to keep people within, because it's damaging to the industry. Otherwise, there's some really powerful solutions that just aren't being adopted at the rate that they should because of these kind of negative connotations. And we're one of those companies that we could have a blockchain-based solution in the market far earlier than we will, because we need to let that play out a little bit.
Yeah.
Right. And so that they're I guess two sides of the same coin, right?
No, absolutely, the breadth, but also the challenges that come with that.
Yeah.
So you mentioned being a lifelong learner. I'd regard that myself, Ferdi. I'm passionate about self-development, improving oneself, and broadening one's mind. What are your influences? What do you read? What do you watch? What do you listen to?
So I read mostly nonfiction. So just a few of the books that come to mind. I've actually been through this process. My godson is just going off to university to study business in the States, Fairfield University. He asked me for some recommendations around books that I read, and so I sent him a list. And so I would include on those books like Shoe Dog, which is the story of Nike, right? Phil Knight. I think it's a great historical story of Nike. Ben Horowitz, who I had the benefit of working alongside for about a year and a half. Ben, when he was at Opsware, obviously Andreessen Horowitz, which he founded with Mark Andreessen, they both worked at Opsware. And so he wrote a number of books, many of which kind of refer back to the era. I think the hard thing about hard things is one that I would super recommend from Ben Horowitz. Also wrote another book, which is What You Do Is Who You Are, and it really talks about company culture, which in this market is very, very difficult to try and influence. Amp It Up by Frank Slootman. Frank is the CEO of Snowflake, and so Frank wrote a great book about how he's managed to kind of move companies to the next level to become absolutely dominant in their markets. And then some of the more, I guess, I'll say they're not quite cliched, but certainly in the private equity space, 0 to 1 by Peter Thiel is a great book. Highly recommend that. I'm reading a book at the moment, which is it's called A Boys in the Boat by Daniel James Brown. It's more of a kind of a team. It's based on the sport of rowing, which I know nothing about, but I heard it recommended, and I'm reading it, and it's excellent. And it focuses on the American rowing team in the 1936 Olympics, which was in Berlin, so against the backdrop of kind of Nazi Germany. But it's really the story of the team and how they gelled, and how lots of individual, very strong athletes kind of came together, but they weren't making it happen because they were kind of working against each other. So it's more of the underlying message is more to do with kind of team building and everybody kind of moving in the same direction. So that's a great book. In terms of podcasts, a little bit more varied. I mix it up. I do listen to the A16 podcast, which is great. simply because you're listening to world experts talk about subjects you would never spend time listening to. But they cover everything, the crypto, the next generation gaming, you name it, everything in between. So that's a great one. At a personal level, Rich Roll, the Rich Roll podcast, he's got some great guests, and it's a combination kind of, Rich is an ultra marathoner. He's, formerly fittest man in the world. But he was, up to his 40s, was kind of the slovenly, overweight, alcoholic. And he wrote this great book, and ultimately, grew the podcast out of that. But just a great advocate for health and ultra marathoning and all that kind of stuff. And I'm a very slow marathon runner, but he was the inspiration actually for that. I used to do a lot of cross country and got involved in business, and much like him, kind of put on weight and not never too much, thankfully, but enough for me to feel like, God, I don't think I could run a half marathon, much less a marathon. But read his book, kind of got back into it, and I've run multiple marathons since. So that's a great inspirational podcast. Who else? Reid Hoffman, the Masters of Scale podcast. Obviously recommend that. But yeah, that's my mostly audiobooks. Although I commute a little bit less now. When I was commuting, I was listening more to audiobooks. But when I run now, I'll stick on an audiobook and lose myself in the story for 45 minutes or however long.
Yeah, I do the same. I listen to much as I can whilst out running or at the gym or whatever else to try and couple that in, especially with driving. But yeah, it's quite a list, and there's a lot there for me to take some notes on as well there, Ferdi. So thank you very much.
Yeah.
If anybody wish to reach out to you, Ferdi, and connect, how best should they do that, please?
Yeah, so I'm very active on LinkedIn. I'm not that active across other social networks, honestly. That's really my most active. So feel free to connect with me on LinkedIn. And very happy to accept connections and give advice or engage in whatever way I can.
Perfect. Well, Ferdi, thank you very much for joining us. I really appreciate your insight. Shared lots of value, especially to see something from kind of an entrepreneurial perspective, but then also moving into then serving and supporting private equity and venture capital firms with their internal processes and being that kind of advocate for change of technology into the actual firms themselves, which I truly believe is a good step. So thank you very much for everything you've shared today.
Thanks, Alex. Appreciate it.
Excellent. And as always, thank you very much for everyone joining us. Should you ever need support with private equity professionals or portfolio executive hiring across Europe and North America, please do reach out to me at Real Selection. If you haven't already done so, please do subscribe and you'll be notified of the next podcast, which comes out every 2 weeks. But till the next time, keep smashing it, and thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.